Let's shift our attention to the broader markets. What's the outlook for 2023? Dhiraj Sachdev, the Managing Director and the Chief Investment Officer at Roha Asset Managers, now joins in. Dhiraj, morning. Rima here. What is the advice that you are giving your clients when it comes to investing now? The next 6 months are still expected to be fairly volatile and turbulent when it comes to global markets. It's hard to predict whether the global markets are going to get into a recession, if not, the extent of recession, how many more rate hikes. So needless to say, it's going to be a very volatile, perhaps, first half of the year. What's the best approach from a market point of view? Which sectors to bet on? Which sectors to avoid?
Yeah, hi, Rima. Good morning. So when we look at India, we continue to believe that domestic growth should withstand global concerns or noise of an impending US recession. Now, firstly, inflation appears to be peaking out with broad softening of commodity prices, though Europe-led crisis is still creating some near-term shortage of energy-intensive commodity chemicals. A bulk of raw material and freight cost pressures are behind, with an expected improvement in profit margins. Now, even Fed appears to have toned down its ultra-hawkish stance, and the narrative will come back on global slowdown versus fighting inflation currently. And with CPI print in US likely to have peaked, the monetary tightening expectations to start moderating, with smaller rate hikes as indicated by US Fed. So while India is not completely decoupled due to export or import trade linkages, a large domestic-centric economy still insulates it to a larger extent. So we are relatively better placed. Market share in exports from China +1 outsourcing is gaining momentum. Higher credit growth from banking sector, shift from unorganized to organized will help India's corporate sector. So overall, if you see, there is a broad-based earnings recovery across banks, financials, industrials, capital goods, autos, real estate, etc. While margins have been cut in second quarter, we expect the margin improvement will be better going forward with fall in raw material costs. And even management commentaries in lending, consumer discretionary, industrials have been quite upbeat. So consumption demand has been robust and it has exceeded even pre-COVID levels. Tax collections have been almost 62% of the budget estimates. Banks are seeing uptick in loans. And importantly, corporate capex is looking after many, many years. And I think this is just the tip of the iceberg. So overall, Indian corporate sector is in much better situation to tackle global slowdown. Now, on the sectors that you asked for, I think we are very positive on Indian manufacturing companies, which have cost competence and driven by import substitution or shift from unorganized to organized or green energy-led growth. We like capital goods because of capex recovery. Banks and financial services, as worst of the asset quality issues are behind. Real estate plays from either legacy land monetization or building products. I mean, cement, despite near-term cost pressures, looks attractive post-correction given the longer runway to growth. We also like select consumer businesses in retail, travel, and hospitality, as they are benefiting from post-COVID opening up of the economy. And finally, while specialty chemicals we talked about earlier as well, there is a structural shift from China +1 strategy. So they are facing near-term challenges on raw material cost issues or inventory destocking happening at the dealer.
Sure. Dhiraj, you spoke about a whole host of sectors, but you also like the defense space. And I want to draw your attention to the discussion that we had with Bharat Dynamics a while back, where they spoke about how their revenues could double over the next 2 to 3 years. And they're sitting on a very robust order pipeline of over 8,000 crores. You like defense PSU, so I'm asking, is there still more to go from a valuation headroom? Or do you think that investors may have perhaps missed the bus on this one?
Defense PSUs are doing extremely well, there is no doubt about it. There is a long runway to growth due to reducing import content with restricted list by India government and more localization efforts. So we believe still that there is a long probably runway to growth over the next 3 to 5 years, though the easy money is already made and some consolidation can happen. And one cannot expect the same kind of returns over the last 6 months or so. So some kind of euphoria is already building up. But from a business perspective, I think staying invested for 3 to 5 years, I think there's still a lot of positivity expected in the business as such, as far as sustainability of the growth is concerned.
All right. Hi, Dhiraj. Good morning. This is Pavitra. What do you think of the space? You know, we have been talking to a lot of these companies. First, we had HCL Tech revising the guidance to the lower band of their range. We've spoken to, a few others as well. They are saying that client spends are getting delayed, not cancelled yet, but, they are getting delayed a little bit. Do you think there's a lot more pain left in this space?
So if you're talking about IT sector, I think the demand is still intact while global clients are cautious. Now, banking financial services, which happens to be the largest vertical as far as IT spending is concerned in the US and Europe, continue to talk of technological investments and their willingness to spend, even as they remain cautious on macro. Now, attrition and higher salary cost pressures seem to be easing, though it is still pretty high, but it seems to be easing. From our perspective, I think the deal wins are likely to be muted given global backdrop, as there are indications of delays in decision making. Over long-term, technological modernization remains a key priority and is viewed as a very necessary and strategic spending by a lot of US companies. However, growth will moderate for IT companies in general in financial year 24. And besides, the valuation of large tier IT companies are expensive, and at best it can deliver mid to high single digit returns due to demand uncertainty from here on.
Okay. Unfortunately, Dhiraj, we're out of time, but thank you very much for joining in. Get into a show.